Let's go back. 1985. Houston, Texas. You're of Kent Lay, son of a Baptist minister from Missouri. The house wasn't rich. You understood what money meant from the time you were very young. Not because you had plenty of it, but because you never had enough. You learned fast. You spoke well. You had a gift, the ability to walk into any room and make every person in it feel like they had just met the smartest man alive. And that man was choosing to trust them. That gift took you far. You earned a PhD in economics. You worked in government. You understood the rules of the energy industry because you had spent years helping write them. And in 1985, you merged two natural gas companies together and gave the new company a name, Enron. At the time, it was simple. Pipelines gas flowed from point A to point B, tangible, real, honest. But you didn't want to sell gas. You wanted to sell the future of gas. You wanted to turn energy into something people could buy and sell like stocks. And you wanted Enron standing in the middle of every single transaction, collecting a fee from both sides. That wasn't greed, not to you. That was vision. And in 1990, you found the person who could turn that vision into a system. His name was Jeff Skilling. Skilling was different from you. You were a man of relationships. He was a man of architecture, fresh out of Harvard Business School, top of his class. He came to you with an idea that sounded insane at first, and then, the longer you listened, the more it sounded like genius. He called it the gas bank. Enron wouldn't just move gas. Enron would trade gas, buy from producers, sell to consumers, lock in long-term contracts, 1 year, 5 years, 20 years out. And instead of waiting to collect revenue as gas actually flowed, you would book the full estimated value of those contracts right now, the moment they were signed. Mark-to-market accounting. The SEC approved it for Enron in 1992. It was legal. It was audited. It was, on paper, a perfectly acceptable way to recognize revenue. The problem you understood but chose not to say out loud, was that the future value of those contracts was an estimate, your estimate. And if your estimate was optimistic or wrong, or simply invented, no one would know for years. You looked at Skilling and saw the one thing you had been waiting for. Someone who wasn't afraid to ask, why not? But for the system to keep working, you needed one more thing. You needed the numbers to stay clean. And that is when Andrew Fastow stepped in. Fastow was young, sharp, and he had a particular talent. He could look at an accounting rule and see everything that rule did not explicitly forbid. His idea was not complicated in principle, only in execution. Enron would create a series of independent subsidiary companies called Special Purpose Entities, or SPEs. On paper, they were separate legal entities. In practice, they were pockets. When Enron had a bad investment, a failing asset, a debt it didn't want on its books, you didn't record it on Enron's balance sheet. You moved it into an SPE. Enron's books stayed clean. Enron's stock kept climbing. When Enron needed cash flow, you sold assets to your own SEEs and recorded that as real revenue. The auditors at Arthur Andersen, one of the most prestigious accounting firms in the world, reviewed the structures. They asked questions, and then they signed off. Because technically, nothing was explicitly against the rules. You didn't call it hiding. You called it optimizing the capital structure. And the first time it worked. The first quarter that should have shown a significant loss, but instead showed steady, predictable growth. You didn't feel excitement. You felt relief. Because Wall Street was satisfied. The stock went up. Investors were happy, and nobody asked to look closer. There is a problem with a system built this way. It only works as long as Enron's stock keeps rising. The SEEs were collateralized by Enron shares. If the stock fell, the SPEs would collapse. If the SEEs collapsed, every hidden debt would flood back onto Enron's balance sheet. If that happened, the real picture would be visible to everyone. You understood this. The circle was right there in front of you. But the stock was rising. And in 1996, Fortune magazine named Enron the most innovative company in America. The first of 6 consecutive years, they would give Enron that title. When you are standing at the top, a circle doesn't look like a trap. It looks like an engine. The year 2000. Enron reported revenues of $111 billion. $111 billion. The stock peaked at $90.75 per share. The Enron Tower in Houston was the tallest building in the city. You flew on a private jet. You had estates. You donated to universities, to churches, to charities, and people put your name on the buildings. President George W. Bush called you Kenny Boy. You weren't just a businessman. You were a symbol. Enron wasn't just trading gas anymore. Enron was trading broadband internet, trading weather derivatives, actual financial contracts on rainfall and temperature. Enron had plans for water, for steel, for paper. Skilling stood in front of shareholders and declared, "Enron is the world's greatest company." No one in that room pushed back, and you, looking down from the upper floors, thought to yourself that perhaps even that wasn't strong enough. But there was one afternoon, an analyst named Richard Grubman, on a live call with investors, asked a question that should not have needed asking. Why is Enron the only major company that cannot produce a balance sheet alongside its earnings release? Skilling paused for just a moment. Then he said, "Thank you very much." Asshole. It was broadcast live. Hundreds of investors were listening. You said nothing. No one said anything. Because Grubman's question was correct. And everyone in that room chose not to acknowledge it. March 2001. A journalist at Fortune, Bethany McLean, published a short article. The headline read, "Is Enron overpriced?" The article didn't accuse. It simply asked, "How exactly does Enron make its money?" You read that piece and felt something cold move through you for the first time. Not because the question was too complicated, but because the real answer, the honest answer, could not be spoken out loud. Skilling flew to New York to meet McLean personally. He explained Enron's business model for 2 hours. She listened, she nodded, and when he left, she still could not explain how Enron made its money. Skilling came back to Houston and told you everything was fine. You didn't believe him, but you let it go. August 2001. Skilling resigned. He said it was for personal reasons. Stress. Exhaustion. You stepped back in as CEO, but on the same day Skilling resigned, there was an email. Sharon Watkins, Enron's vice president, someone who had worked directly with Fastow structures, sent it straight to you. She wrote, "I am incredibly nervous that we will implode in a wave of accounting scandals." She listed the names of the FCEs. She explained clearly why the structures could not hold. You read that email. You called your lawyers. Your lawyers told you that Watkins didn't have enough standing to go further, that the SPE structures, technically, remained within legal boundaries. You did not fire Watkins. You also did not fix anything. You called the banks and asked for a new line of credit. October 2001, Enron announced a loss of $618 million for the quarter, the first in years. Buried inside that announcement was a single line: a reduction of $1.2 billion in shareholder equity due to, quote, related party transactions. The Securities and Exchange Commission opened an investigation. You stood in front of cameras and said that Enron had strong fundamentals, that this was a temporary adjustment, that you believed in this company. But that night, you lay still and stared at the ceiling. You weren't calculating anymore. There was nothing left to calculate. You already knew. The circle was closing. November 2001. Every day the stock fell further. $90, $60, $30, $10. The SPEs began to collapse. Exactly as the structure was always built to collapse once the stock fell far enough. The hidden debts came flooding back. The real balance sheet began to surface. Enron needed $690 million immediately just to stay solvent. You called Dineji, a competing energy company, and offered to sell Enron for $10 billion. 1 month earlier, Enron had been valued at $60 billion. Dineji agreed in principle. Then Dineji looked at the actual books, and Dineji walked away. November 28th. 3 credit rating agencies downgraded Enron to junk status simultaneously. The banks stopped lending. The trading partners stopped trading. Your phone rang continuously that day, but there was no one on the other end you wanted to hear. December 2nd, 2001. Enron filed for bankruptcy, $63 billion in assets. The largest corporate bankruptcy in American history at that time. On the same day, more than 20,000 employees received notice. They didn't just lose their jobs. Enron's retirement plan, which the company had actively encouraged employees to load with Enron stock, had lost almost all of its value. People who had worked 20-30 years lost their entire life savings. They found out on the same day you filed. Where were you that day? Not at the office, not in Houston. You were at home, and the first thing you reached for, according to those close to you, was not the thought of 20,000 employees. It was your attorney, 2006. You sat in federal court in Houston. Skilling sat beside you. The prosecutors asked you hundreds of questions over weeks. You didn't recall. You didn't know. You weren't involved. You said you had been deceived by Fasto, that you had trusted your team and been betrayed. The jury listened to you for 4 weeks. Then they convicted you on 10 of 11 counts. On July 5, 2006, 6 weeks after the verdict, before sentencing, you died of a heart attack. You never spent a single day in prison. But the question isn't about the verdict. The question is, when did you actually know? Not the day Enron collapsed. Not the month the SEC began investigating. The question is, on some quiet any of that, when you sat alone with the real numbers in front of you, did you look at them? Did you understand that the company you had built was standing on a foundation that, if anyone looked carefully enough, had nothing real beneath it? And did you choose not to look carefully? Not because you couldn't, but because if you looked, you would have to do something. And doing something meant watching everything you had built collapse under your own hands. So you didn't look. You let other people keep looking for you and keep telling you that everything was fine. Was that a choice or just a silence you decided to keep? And that is what Kenneth Lay, Jeff Skilling, and Andrew Fastow lived through. 3 people, 3 roles, 1 system. Lay, the man who lit the fire and chose not to ask what it was burning. Skilling, the man who believed that intelligence was a sufficient substitute for honesty. Fastow, the architect who built the black boxes, who served 6 years in prison, who became a government witness, and who was released because he was willing to say the things the others refused to say. But there is a larger question that belongs to all of us. Enron did not collapse in a single day. It collapsed over years. While dozens of banks, hundreds of analysts, the largest accounting firm in the world, and the government regulators, whose entire purpose was oversight, all chose, collectively, not to ask the obvious questions. Why? Because Enron was giving them exactly what they wanted. Beautiful numbers, a rising stock, a story about American innovation and limitless possibility. And when you are profiting from a system, genuinely, consistently profiting, you do not want to ask whether that system is real. That is not a story about one fraudulent company. That is a story about what happens when an entire ecosystem, from the CEO to the auditor to the regulator, is incentivized to believe what it wants to believe. After Enron, the United States passed the Sarbanes-Oxley Act. CEOs and CFOs were now required to personally certify the accuracy of financial statements. A false certification meant criminal liability. Arthur Andersen, one of the 5 largest accounting firms on earth, ceased to exist. But the structures didn't disappear. SPEs still exist under different names. Complex financial instruments are still designed to be technically legal and practically invisible. And 7 years after Enron, in 2008, we sat here again and asked ourselves why nobody asked the right questions. Here is the question I'll leave with you. If you had been working at Enron in the year 2000, not in the executive suite, not in Fastow's inner circle, just an ordinary employee, being paid well, watching your stock options grow, being told every day that you worked for the greatest company in the world, would you have asked? Or would you have chosen quietly not to look too closely